So it's the top of the hour right now. People still getting in. Let me give them about 30 seconds to get in. So although stuff at the beginning is just housekeeping, so maybe we'll get into the housekeeping so we get to everything today. So thanks everybody for being here. As long as I see that number keep going up, I just want to hesitate a second, but I'm going to get going. Thanks everybody for being here today. Just a quick, if anybody can give me in the chat, we hear you, Randy. We see you, Randy. Anything like that, just so I know we're communicating well today. I can see a couple of chats go in, say everything looks good. It looks like everything looks good. Thanks, everybody. Appreciate it. Oh, and I see some familiar names in there too, which is nice to see. So today's presentation, you see the gigantic long title. We tried to see how many letters we could fit on one page to determine the title for this one, but it's an interesting title because it's going to concentrate on new things, specifically new things in R&D, not just only R&D tax credit, but new things in R&D expenses. And so there's been some interesting things happening in this month alone to R&D in general. And so that's where we're going to spend the majority of the time. But then there's other areas that have either been affected in the last month or two or lack of effect that we expected, typically through the Build Back Better bill. So we're going to touch on that because we expect some of those to come through as well. So there's the title. New information, new guidance on R&D and R&D expenses is a majority of it. All right, housekeeping. This is available for CPE. If you want CPE, make sure you answer 3 of the 4 polling questions that will pop up during the presentation. Obviously, I will announce those, and you'll have about a minute to answer the question. Get that submitted in. If you are going to ask questions today, do that through the Q&A if possible. This way that we know that there's some questions coming in and we know we need to address some. So put those in the Q&A if at all possible. And for the CPE, we will send out the certificate along with a copy of the presentation to the email you registered with. So take a look out for that. You can see that handsome man in the picture on the video, John Kapral. John is going to be doing some of the presentation with me today. John, as you can see, he's got a lot of letters after his name. And so he's gone through a lot of schooling, but you can see that it pays off. He does a lot of research. John himself was shooting out emails at 1:30 this morning on things we're going to talk about today. And I think I woke up at 4:30 this morning to read those emails because I had Code Section 174 and Code Section 41 on my brain, and I needed to do some more research yet this morning. So John and I will tag team a little bit on this presentation. You can see his history. He's been working in credits and incentives for the last 16 years now. I've known John for that long. Thrilled that he came to work with us last year, the end of last year, after spending 5 years at Clifton Larson Allen, heading up the Western region. So John, like I said, will be part of the presentation today. Myself, I did see familiar names. I'm guessing you've seen this before, but a quick introduction to me. I am a CPA. I came out of public accounting. I was managing partner of a firm in the Chicago suburbs before starting Tri-Merit 15 years ago. And this is our 15-year anniversary coming up in a couple of months from now. So very excited about that. I do these webinars all the time. I've been writing articles for Accounting Today, mainly on just different topics, which has been a lot of fun. And I host a podcast called the Unique CPA, where we talk about interesting things happening in public accounting. Watch out for that because we're turning the podcast into CPE. That should be coming out shortly, where the podcast, you'll be able to get CPE for listening to the podcast. So watch for that. We'll be announcing that shortly. And then just to brag for a second, and this is a company brag really, but I'm the one that got the recognition. Accounting Today didn't put me in the top 100 most influential list, but it named me as one of 20 people to watch going forward for the good work I think we're doing as a company in the industry. So that was pretty cool to see that they put that out there. All right, so who's Tri-Merit? We are a specialty tax firm. We support tax preparers. We give them information, advice, documentation, everything they need to help lessen the tax burden for their clients through some specialty area. R&D is how we started. Over the years, we've added cost seg, WOTC, some energy incentives, 178D and 45L, and then the last year, employee retention credit, which has been a hot topic, obviously. And we're going to touch on that a second at the end today. We're made up of engineers, scientists, CPAs. Engineers are very important because a lot of things we do, like R&D and cost seg and 179D and 45L have engineering aspects to it. As you saw by John's initials, he's one of the, I think, 6 or 7 attorneys we have on staff as well, which are important just in research and interpreting tax law and everything else. And we do cover the entire country. We've done work, I think, in pretty much every state at this point. All right. On to why we're here today, on to that long, and I didn't change the title to this one on this page. So this is the wrong title there, but that's why I was up at 4:30 knowing something would go wrong. What we're really doing is talking about these updates to R&D, updates to R&D credit and expenses, 178D, 45L. We expect updates to come, so we're going to highlight what those updates are that have been proposed in the BBB, whether you want to call it BBBA or BBBB, or just BBB. We'll highlight that. And then employee retention credit. There's some pretty interesting information that just came out on that this week that we're going to want to touch on at the end as well. We're going to start off immediately with the polling question so we can get that out of the way. So I'm going to launch poll number 1, and hopefully I typed these correctly. We shall see. Have you claimed R&D tax credits on amended tax returns? I'm going to give this a minute. That gives you a little preview of one of the first things we're going to talk about is the change that came on how we're going to have to file amended tax returns in the future. The future is now, actually. We're living in the future for that. So that's one of the first things we're going to talk about is the R&D and these new rules that came into play. All right, we're at 87% of you had voted. I'm going to either assume you don't need CPE or you're not listening to me. So hopefully it's you don't need CPE at this point, and because I'm going to close this in about 3 seconds here. All right, I still see some votes coming in, 89%. All right, I'm closing it. If you didn't get this, you got 4 more or 3 more you can end with. Wow, one person just got in under the gun there. 66% of you have claimed an R&D tax credit claim on an amended tax return. So that's going to be interesting to talk about. First thing, R&D. I'm going to set the stage for R&D. If you've been on any of my webinars, you've heard this, but I'm going to do this very fast. What is R&D? Because we need to know what R&D is when we talk about these changes, because everything that you see listed on this page is going to come into play with these changes and the next page as well. So how do you qualify for R&D? You put your client's projects up against a 4-part test. If they meet this 4-part test, plus an overriding factor at the end, they're going to qualify that project for R&D. And project's important. Project is key when we're going to talk about what the changes are here. So first thing is the projects, have they met the permitted purpose that was defined in Code Section 41? Code Section 41, you're going to hear me spout Code Sections 2. And 41 defines the R&D tax credit. Code Section 174 defines R&D expenses. And those two are going to be key things we discussed today. So in 41, permitted purpose, do we have a new or improved product, process, technique, formula, invention, or software? If so, we've met that first part. Number 2, does this project have some kind of technology involved with it? Computer science, chemistry, biology, engineering, some kind of hard science involved in the project? If so, we've met number 2. Number 3, is there uncertainty in this project? And that can be ultimate. Can we even do this? But it doesn't have to be that. It can be, can I do this better, faster, cheaper, more efficient, have less time involved, less waste, less operations, some uncertainty of how to move forward with whether it's a manufacturing product or a software development or whatever the aspect is that's qualifying. What level of uncertainty do we have on that? And if we have uncertainty, the 4th part comes into play, which is experimentation. In experimentation, I'm going to evaluate different alternatives, different iterations of a project to see if I can answer this question I have. I'm trying to discover something. Can I discover this? Can I eliminate uncertainty? Can I do this better, faster, cheaper? Can I do this at all? That's experimentation. That's key to the R&D tax credit. And they're all going to be key to things we discuss going forward. And then just an overriding factor, you can have all those parts, but if you don't take an economic risk on for this project, you don't get the credit. And simple example, I'm a software developer. Someone asked me to develop a product for them. I tell them I can do it for them, and I'm going to charge them $200 an hour, and they're going to keep paying me. And if I can't do it, they've paid me. I get paid either way. I didn't take on the risk. The client took on the risk because they don't know if they're going to get a successful project. They just know they're paying me $200 an hour to try to develop this for them. That was the client taking on the risk. Now, me as a software developer, someone needs me to develop a product for them. I say, yeah, I can do that for 20 grand. And now I have uncertainty. Now I'm at the 4-part test, and I don't get paid in that 20 grand unless I develop a product that I can deliver to this client. Now I took on the risk. So you can get paid. It's just a matter of who's taking on the risk of not getting paid for this project. And so that's just a simple example. All right, so now we have a project that qualifies. Now we want to see if we can quantify the dollars that go into this. Again, this is going to be important, but what are the expenses, salaries and wages? Who in our company is doing design, testing, evaluating, prototyping, CAD work? Who is doing that? So we want their salaries and wages. Are we outsourcing some of those qualified activities? If so, we can take that in. Have we consumed supplies in the process? And I'm not going to go into it now, but supply cost, material cost, based on some new prototype rules, could have increased significantly in the last 5 or 6 years for many taxpayers. So supply costs going into the calculation of the credit, and then rental of computer time. It's funny, in the IRS's new guidance on claiming R&D tax credit claims, they don't talk about the rental of computer time, at least that I've noticed. So they really concentrated just on those first 3. So those first 3 are going to be highlighted in what we talk about next. Now, so that's the background. Just wanted to give you a quick update, get you up to speed on R&D. Now, what's happened recently? Why are we doing this webinar? What are we going to discuss? Well, IRS came out with some guidance, a news release actually on October 15th, which is actually kind of a weird way that they announced this through a news release, but this is what they did. October 15th, they had a news release based on a memorandum that they put out on September 17th. So they waited 4 weeks to tell us about this memorandum. But in this news release, they talk about new processes we have to go through if we are claiming refunds on research credits. They actually say research credit claim refunds, code section 41. That was a little confusing when it came out, because what does that mean? Does that mean that anytime we're getting a refund, we have to follow these new procedures? They have since clarified this to say anytime we are filing an amended tax return claiming an R&D tax credit, we're going to have to follow these new procedures. That same date on October 15th that they released that memorandum, they released a news release that explains what the memorandum said. And so that happened October 15th. In there, it told us, okay, you're going to have to start following these new rules on January 10th of 22. So, we live in the time that these new rules exist now. So we have to be paying attention to this. On January 3rd of this year, so a week before these rules went live, January 3rd of this year, they put out the interim guidance. So we knew something additional was going to come. We knew there was going to be additional information that we needed to know about on how to do this. And so on January 3rd, they gave us this additional interim guidance on claims for refunds that include R&D credit claims on amended tax returns. That whole sentence is, that first sentence, that release is their definition. It doesn't say amended. When we get to the FAQs, they say on amended returns. So they released an FAQ at that same time that said the research claims on amended returns. Here's your FAQs for that. That's the background. That's why we're here today. That's what's happened. So this all happened in a very truncated time. I mean, we had a less than a 2-month period that we heard about this till we had to put this into action. And so what does this say now? Amended tax returns, we have to submit 5 additional pieces of information. It's really 4 up and above what we've done before, but they list out 5 up and above what we've always done before. In the past, when we file an R&D tax credit claim, we file Form 6765, boom, we're done. Now that's what's front facing. That's what the IRS sees. That's not what we would do from a documentation standpoint, but that's what the IRS wanted to see. going forward now, what they've said is, and here's the first thing, what they've said is when we are submitting this refund claim on an amended tax return, we have to identify every business component that this claim is based on. Every business component, product, process, technique, formula, invention, or software, every single individual one of those that this credit for the year, let's say 2022, is based on. And a business component is those things, and it's defined as something that we are either going to sell, lease, or license, or a product that we are going to use internally. We developed a piece of machinery, we're going to use that internally. That can be a new or improved product or process. So we have to identify every business component that this is based on. Then they go further and they say, based on that business component now, you're going to need to identify every research activity that happened on that business component, everything that you were doing on that. Who were the individuals? Number two, on the business component level, who were the individuals within the company that were working on that business component? And then what was each individual looking to discover? What were they trying to overcome? What was their uncertainty they were working on? What was the activities they were trying to discover? What were they trying to do that was better, faster, cheaper, more efficient, or even do it in general? So identify the business components at the business component level, not the company level, but the business component level. Each activity that was happening on that business component, what the discovery was trying to be done on that business component, and who was working on those activities and trying to discover that information. That's all significant new information, and it has to be submitted with an R&D tax credit claim on an amended tax return. The fifth thing they said was, in addition, you need to tell us the total wages for the credit, the total qualified supply expenses, and the total outsource expenses, or they call contract research expenses, for that claim year. Now that already happens on Form 6765. So John may, when we get to John, he may be able to expand on that, because I honestly don't know why they asked for that in this, because it's already submitted. My first thought was they wanted that at the business component level, but in their clarifications, they have not said that. They're just saying total. And they're actually saying that Form 6765 will take care of that requirement. So it already is taken care of on the form submission. All right, let's dig a little deeper on what the IRS is then saying on these applications for amended return refunds. First, all the research activities performed by business component. What do we do? How do we tell them that? Well, we have to tell them put a description of everything that we did, how we did it on each business component. This is their language here. They go further to say, in addition, you're going to need to put a list, a table, or a narrative down that's going to list every individual that was working and what the research activity was that they were working on. Now, I highlighted or title or position, because originally when October 15th, when this came out, they said, you have to list the name of each individual employee that's working on this. In the January 3rd release, they've said you can put title and position in lieu of the names as well. Don't know if that's important or not important. Another thing they actually said in that same scenario, in that same area, is if a group of individuals within the company are working on the same type of activity or trying to discover the same type of information, you can actually lump those together in this submission. But again, at the business component level. So this is the next part. And then again, at the business component level, a list, table, narrative providing the information each individual or individual's title name was looking to discover. So that's a lot of additional information. Lot is a technical term. That's a lot of additional information that needs to go with the filing. They haven't actually specifically, again, unless John knows different, said how to do this. My guess is, you can, I know you on electronic filings, you can attach some PDFs potentially and stuff. That's my guess is how they're going to want this. But that's what they're looking for going forward. Now, additional information on what they've told us. We are now in a transition period. This is a year where they're going to evaluate how this is going. This is a year where if they find deficiencies in your filing, they are going to send you a letter, and you can see the form of it there, that says, hey, we didn't accept your filing. We're going to give you 45 days to perfect that filing. Here's what we determined was missing or what was an issue when you sent this in to us. You have 45 days to do this. Now, we are in a transition period till January 9th of 2023. So it was January 10th of 22 to January 9th of 23 is the transition period. During this time, they're actually asking for feedback too. So I put the email address there on where you can send, and you'll get copies of the slides. But where you can send your feedback on what you think about this, I guess be nice, but what you think about this, what you would like to see changed, what you think is good, anything you want to submit, you can do that there. That was just additional information they gave us. And then they've also said in this FAQs, hey, you need to certify that what you're giving us is true and accurate, and therefore you need to sign this. Well, they've come out in the clarification and say, hey, signing the tax return is you declaring that what you submitted is accurate. And so that's, you don't have to sign something separate. That alone should be enough. IRS promises to us on this now. IRS promises to do everything they possibly can to look at this within 6 months of filing it. I mean, I'm hoping that's true based on ERC, which is a different process, but based on ERC, we know that they're taking a long time and processing things. I'm sure they've set up a different system for this. It is not paper filing like ERC, so maybe that'll speed it up a little bit, but they're saying, yes, they're going to make every effort to get back to you with a yes, we accepted your claim, or no, we didn't, and here's what we need you to give us to perfect this. If you do need to perfect this, the IRS is asking that you fax in your response to their deficient notice. Obviously, faxing, we're all living in the 1980s now, so faxing is really the best way to get information out to obviously it's security and everything else. Sometime there'll be such a secure email system or they'll put an upload system that it'll be easier. But right now, they're asking that we fax. I can't even say fax anymore. That word is so old. Fax this information in, but they will accept mail responses as well, which my guess is you've seen what mail responses are doing right now. Don't expect anything for a year and a half if you're going to mail in a response. Hopefully the fax response would be quicker. Couple more things that they told us in this clarification. Hey, you can use I can't talk at all today. Statistical, John, you may have to jump in and just start doing my words for me. Statistical sampling, you can use that to do your R&D tax credit calculation. You can still do that. If you are, you have to follow these rules for the projects that came in the statistical, forget that word. The S sampling, you have to use that same information, and you're able to submit it using statistical sampling. And then what I just wanted to point this out real quick, because now what are we thinking? Are we thinking, okay, this is going to be, why are we even going to file an amended tax return anymore? We're going to get audited. It's going to be a pain. I just want to tell you in general, everything that they ask for, you should be doing already. This is not new to the world stuff. This is not R&D tax credit worthy stuff from a standpoint that is new to the world and needs to qualify. This is stuff you've had to do. We built Tri-Merit based on the fact that this is information that we need to do at the project level from the beginning. And so what I want to point out is we've been through audits. For some reason, we only get about 1% of our federal returns audited. In that scenario, 61% end up in no change at all, which is a good percentage. But if we do have a change, we retained 87.5% of the credits in that scenario. I mean, if you looked at all of our returns, we retain 99.9% of all the claims just because most of them aren't audited. But in the ones that are, we're retaining 87.5. So if you have this information put together accurately, you should be fine with the submission, and just be aware that there's no issues. There shouldn't be an issue. It's stuff that should be kept already. Now, that being said, no show of hands, but I'm sure at some point we have all looked at a client. I'm not going to say we have internally, but a tax preparer, and when I was in public before this, I looked at a client, they had 2 engineers on staff. I decided let's take those 2 engineers in the calculation of credit and submit a very conservative R&D tax credit because I'm just basing it on 2 individuals. it's probably very conservative. It probably could be defended. It just can't be defended without putting all this documentation together anymore. So that's one thing that can't be done anymore. Now, this being on amended returns, okay, going forward, currently filed returns, we don't have to do this. Well, we still need the documentation. I honestly could see at the end of this transition period, if IRS is comfortable with the way this went, I could see where they can say, yes, we're going to ask for this on all R&D tax credit submissions now going forward. So just be aware that that may be coming down the road. With that being said, before I go to polling question number 2, I want John to come on because I want John to give us just a little bit of background of how we got here. How did this whole thing come about? How did we get surprised by this thing on October 15th? But what was IRS doing behind the scenes to base this? John, you want to give us a little education on that?
Sure. Thanks, Randy. And hello, everyone. Glad to have you here with us and to be sharing some of this with you. It's always a good idea to understand the precedent to changes like this. And this was fairly substantial. This did catch most practitioners by some surprise because of the breadth of it and the stealth of it. This chief counsel advice memorandum and following and then the follow-on guidance. So what had happened here, what looks like it to have been happening for a few years now, is IRS has been developing a new line of argument to push back on IRS on FT claims for the federal tax credit for the R&D. And so what they've been doing is going to the procedural aspects of a filing, looking at the documentation provided and determining that it is insufficient. And again, this is a subjective determination that IRS has been making. They did this in a series of cases, and it was quietly raised. And in each of those 3 cases, this idea that taxpayer had provided insufficient specificity to get a claim for a R&D tax credit, they lost in all 3 cases. And they lost pretty handily. And the reason is the court looked at IRS and the fact that they had put the taxpayers through an ordeal of a multi-year audit. And if anyone's been through an audit, you understand what that is like, especially for R&D credits, because they are a particular target. In addition, taxpayer had provided not only fully complied with tax documentation in the original returns and in the amended returns. What they also did was provide tens of thousands of documents, hours of testimony, oral and written testimony. And the court looked at all of that collectively. And in each of these cases, more or less, said, IRS, you're not going to win on this argument because taxpayer, not only did they provide your forms fully complied and prepared, they've given you all of this documentation over a period of years under audit. And so IRS, you've had plenty of time, sufficient time to determine whether this claim was sufficient. And so this is almost a threshold question, gateway issue that is rarely examined in R&D tax credits until the last few years. Now, IRS lost on all of these arguments. And so what Treasury did is they came up with this chief counsel advice memorandum that literally requested taxpayers to file these amended returns with all of this documentation, the nexus, the people to projects by activity and time in great detail, much greater detail than we've ever had to do before in a filing, in a claim for refund. And so they ignored the court essentially, and now are requiring it as a procedural matter before they will even evaluate the merits of the R&D credit. What I mean by that is, again, it's threshold. If IRS determines taxpayer has not filed enough documentary evidence to provide this, what they're essentially considering as nexus. By failing to do that, and again, it's a subjective degree of evaluation, taxpayers may never get an opportunity to have their claim reviewed on its merits. And that's the worst case. And so what that puts us as practitioners is in a position where we have to evaluate how do we advise and what do we do in response to this CCAM. And consensus is there will be compliance with this guidance. And although not substantial authority, it is guidance that we can use to help us understand how to advise our clients, you as CPAs, to best sustain their R&D credits. And so this is a long multi-year process that it took to get here, but it was done very quietly, which is interesting for different reasons. But that is where we are, and that is why we are looking at this as not so much a change in our best practices. We've been doing a lot of this to begin with. Some of the areas we are going to be bolstering because there are highlighted opportunities to meet IRS requirements and perhaps even avoid an audit. That is the key here, to get credit claims through the process as quickly as possible. And that is why we are going to do our best practice adjustments to comply with this guidance. And so that's why we're here today.
All right. Well, John, thank you so much. Your insights are always, I'm just riveted listening to all the knowledge you have there. So thank you for that. I'm going to launch polling question 2 here. A little bit information gathering on my end. Do you think R&D tax credit claims on amended returns will decrease significantly? And I know I'm probably going to get a significantly yes answer here. I don't think it should be. I mean, there's still, as long as you can defend it. If you can't defend it, you shouldn't be taking it in the first place. And I agree, then don't do it. But if you can defend it, at this point, this isn't an audit. This is just a yes or no. Hey, yeah, we accept it. No, we didn't accept it. But at minimum, we're seeing what they want to, they send back to us. So yeah, I mean, your opinion is your opinion. And I completely agree that this will probably scare people away. I don't think it will. And I honestly, when we get to the next section, I'm a spoiler alert. I think the next section that we're going to discuss will increase people's desire to claim R&D tax credits. So, all right, we're at 85% submitted on this. I'm going to move on to the next because I knew this section would take quite a while, and I want to get on to at least the next section. The last few, if we don't get to, we don't get to, because they're stuff that we can talk about anytime. I'm ending the poll. We're at 61% saying yes, you expect that this will change how people are claiming R&D tax credit on amended returns. All right, next section. Next section is R&D expenses. We had 2 major things that happened in January. The first one we just discussed, the new claims for amended returns. The next one happened in January, but was defined over 4 years ago. And that is starting January 1st of 2022, we now have to capitalize R&D expenses. This is new. We had the option of capitalizing R&D expenses in the past. We did not have to. And I'll bet 95% of your clients or even more made an election to expense R&D expenses as were incurred, and your clients didn't even know they did that. They did it simply by expensing R&D expenses on the tax return the first year they had them, whether they called them out as 174 expenses, which defines R&D expenses, or not. They may have been hidden in salaries and wages. They may have been hidden other places on the tax return. They may have been hidden in a 162 expense, ordinary expense, even though it was a 174 expense. By doing that, your clients made this election to expense it. And as all small taxpayers really want, we want to reduce that tax bill as much as possible. That's no longer the case. The way we are right now, in the year 2022, our clients have to capitalize R&D expenses and amortize them. If it's a US based R&D project or expense, They get to amortize that over 5 years. If it's a non-US based R&D expense, they have to amortize that over 15 years. That alone could, make anybody think about, if I'm doing R&D, maybe I should be bringing that to the US rather than doing that overseas, because now I get a quicker write-off. At least it's 5 years rather than 15 years if it's non-US based. That's one positive of this, the way this bill's written. The negative is we don't want to capitalize. Our clients want to expense it. Your clients all want to expense it. This was assumed would go away when it was first defined. I mean, I talked about this for 2 to 3 years after the Tax Cut and Jobs Act, that this was out there. Be aware, this is coming, kind of alarming everybody somewhat, but then telling them, but honestly, I don't think this is ever going to come into play. I think there'll be a bill out there that's going to change this before we have to start capitalizing R&D expenses. And again, this is expenses. This has nothing to do with the R&D tax credit directly. Indirectly, there is going to be an effect, but directly, this is a 174 rule, not a 41 rule. And so this was scheduled to be not eliminated, but this was scheduled to have this can kicked down the road in the Build Back Better bill, or the Build Back Better Act, whatever you want to call it. But we know where that stands right now. Well, I don't know if we do know where that stands right now. We just know it's not going anywhere currently. And so as we sit right now, this is there. We have to start capitalizing. Hopefully it goes away before the end of the year, but I don't think we can count on that right now. I mean, election year, all this stuff, I don't think we can count on it. So we're going to have to plan for this. At a minimum, we're going to have to deal with our clients and letting them know what's going on right now. So we live in a time, again, where we have to capitalize R&D expenses. What does that mean then to the credit? So the capitalization is pretty straightforward. Boom, we have R&D expenses, 174 expenses, which 174 expenses will always exceed 41 expenses, because not everything that qualifies as an R&D expense qualifies for the R&D tax credit. But what's going to happen now is, how's this going to affect the credit? Well, there's some positive news, at least on this aspect, because the question is, for the R&D tax credit, do we just get to use the amortized amount every year in the calculation of the credit, or we get to use the expenses incurred during the year into the calculation of the credit? Because if it's amortized expenses, that first year, we are only actually get 10% of the deductions amortized, because we use a mid-year convention on it. And so you would have very few R&D expenses available for the credit. Fortunately, in the Tax Cut and Jobs Act, they had foresight to make amendments in there that say, the credit is not affected by these rules. You still get to use the expenses paid or incurred during the year for the calculation of the credit. In my mind, that alone, you're going to have a significant increase on your tax return because you're capitalizing R&D expenses. If you had not claimed the R&D tax credit in the past, and a lot of clients haven't, they just didn't want to deal with it for whatever reason. And they get scared of it sometimes too, because they think it's something the IRS is going to audit. Well, you can see based on our audit rates, we don't see a lot of audits, but that's a concern out there. And I'm not going to promise you won't get audited, because there's definitely audits out there. But I think the clients are going to be more likely now to look, how am I going to offset this additional tax I'm going to have because of these 174 capitalization rules? So I think R&D credits will be more looked at. And even if this goes away, I think more clients should start looking at it anyway. Well, I guess I sound selfish on that, because we do that as a job, but really it's a legitimate credit out there, and the time consuming, the ROI on it for most taxpayers is significant. One thing, and I'm not going to expand on this, but also in the Tax Cut and Jobs Act, it talked how we do the 280C election. 280C, we have to either take a reduced credit, or we have to take a full credit and reduce expenses. They talked about how that would be affected by capitalization, and there's more, for the most part, it's not going to be a lot of effect. I want to give you an example. So I want to put this out in the numbers, and how is this going to affect our taxpayers? Let's say we have a company that has $1 million of R&D expenses on an annual basis. They may not even know they have $1 million of R&D expenses. If they're a manufacturer, they have R&D expenses. If they're a manufacturer and they didn't take the R&D tax credit, they still have R&D expenses. They just do. I think I can say with certain 99+% of manufacturers are going to have an R&D expense. If they file a tax return where this is not included as a capitalized cost, obviously they're going to be an audit target. So audits in general could go up just because of these rules. But in this scenario, we have a company that has $1 million of R&D expenses, which is probably a $8 to $10 million manufacturer. It's not out of the question they have expenses this high. Let's assume it's an $8 million manufacturer. Let's assume that 80% of their 174 expenses qualified for 41. That's common with the clients we work with. That's not always a good percentage, depending on the industry you're working with. You can see each year they're going to start amortizing these expenses. The first year, since it's a mid-year convention, we only going to get a 10% of those costs amortized. We're going to get a $100,000 deduction that first year instead of $1 million deduction. You can see in a couple lines over, we've increased our net income by 900,000. If we assume this is a pass-through, and let's just say the rate that they're being taxed at is 35, which I'm just picking, let's say a blended rate here, 35%, that's a $315,000 additional tax hit to this $8 million manufacturer in this first year. This is significant. This is a big deal. We have to be looking at this now. This scenario with this client I'm talking about here, I'm assuming that their R&D expenses are consistent every year, which is probably not the case, but let's assume that. If they took an R&D tax credit, the reduced credit in this scenario would be 41,000. So they offset some of this additional tax. So their net increase in the first year is 273,000. What you can see here by year 2027, because now I've got almost a full amortization. I'm amortizing $900,000 of expenses in 2027. 200,000 for the last 3 years each, plus 200,000 for the current year, plus 100. Bottom line, $900,000 of amortization in this year. I have an additional tax of 35,000. By claiming the credit, I'm offsetting all that tax plus getting some refund. And then come 2028, since all my numbers are equal every year, I have 100% amortization. I'm overall net back to where I was in 2021. But in this scenario, if I wasn't taking the R&D tax credit, I've paid $875,000 of additional tax in this period that I'm never going to get back. That's just gone. Now, going forward, I'm back to even, because now every year I'm going to have the same amortization, a total 5-year amortization, and I'm going to be back to even, and I'm going to get the benefit of that credit. I'm going to have a $41,000 savings every year. But this is a temporary hit to most if they're consistent on their numbers. If in this scenario we have a 10% increase each year, you can see come 2028, I still have an additional tax from this every year. Now my credit's going up. I'm offsetting a big portion of that additional tax, but this capitalization rule for a growing company is going to hurt. Now in this scenario, I'm really going to want to take that credit, because at least over that 6-year period here, I saved 371,000. I'm offsetting in that 6th year. I'm at least offsetting most of this additional tax, but this is something that's going to hurt. This is going to hurt manufacturing in general, because the decision is going to be made is, do I want to be doing R&D in the US? Do I want to be doing R&D at all? Do I want to just be a distributor now, and I can start buying these products from somewhere overseas where they're getting a credit and they're more, there's more incentive out there for them to do this. This is why I think we have a good chance that this will go away before the year's up. But like I said, we cannot count on that right now. Before I move on to, I'm going to pull up polling question number 3. And while I do that, John, is there anything that you want to add on the 174 rules?
Just the, we do have the authority, Randy. It's pretty clear to support this, the fact that we're not going to need to just take the 1/5 of QRE in the current year for the R&D credit. That would be potentially limited. It's the 280 cap C rule is going to change significantly because, as you described, it's going to be based on the actual QRE and the actual credit year by year, and that difference in years that the credit exceeds the expense at time, and that can happen in certain circumstances. It's going to be an annual part of the process of computing the R&D tax credits, whether the 280 cap C election is made or not. And it could be very favorable to taxpayers by giving them a larger credit in most years.
Yep. Nope. That's a good point. The 280C, if you're a pass through or certain entities, it makes sense to take a reduced credits because you're going to get 79 cents on a dollar rather than passing through additional tax and being taxed at 35%. So it's going to make more decisions come into play. We're at 85% of answered on this poll. I'm going to end the poll. 2/3 of you think that clients will be more likely to look at R&D tax credits going forward because of these 174 rules, which I think they should. It's definitely worth it. All right, let's move on. Those are the two major things that we wanted to touch on. Now, these are major as well, but that's where I knew we would spend most of our time. What I want to talk about real quick, because there's some proposals out there to be aware of on 179D and 45L. So 179D, the energy efficient commercial building deduction, it's basically accelerated depreciation. If we can show our property is more energy efficient, you can get up to $1.80 a square foot deduction. This is available for building owners and designers of government buildings. The new law that was proposed in the BBBA or BBBB, I like the BBBB better, is not only going to allow government entities to allocate this to the designers of their buildings, it's adding tax exempt entities to be able to do this as well. We think a version of this will pass. We think this will happen again. Am I crossing my fingers? Am I counting on this? Am I going to bet on it? Not at this time, but it already was in the Build Back Better bill. This is how it was written. It not only gives tax exempt the ability to allocate this to designers, which is huge. I've been asked this for years if that would happen, and it has been talked about in the past. Now, at least it made it into a major tax proposal. In addition, we're looking at increasing the benefit where we can get up to potentially $5 a foot in certain scenarios based on bonuses that kick into play. I'm not going to go deep. Just be aware 179D could get a significant bump if a version of the BBB or if it gets put into another bill as well. 45L, same thing. 45L expired the end of last year. So right now we don't have 45L. What is it? It's a credit for developers of residential property that's energy efficient. BBB was supposed to extend this. Well, currently this is a $2,000 per unit credit. Bottom line, it's for residential property. If we can show they're more energy efficient. The BBBA was going to extend this for 10 years. I think the longest extension we probably ever had on 45L. It's always been extended ever since it was defined in 2006. This would have been by far the longest I think that's ever happened. It's a $2,000 per unit credit. The BBBA was also going to enhance this credit, could have been up to a $5,000 credit if you met certain bonus requirements within the property. And so this would have been a nice stimulus to our industry, or to a residential property as well. Those two, 45L and the 179D, we really think a version of that will happen this year. 179D still exists. That is permanent. It's just not the enhanced 179D like the BBB was going to propose. So just be aware, watch that, see what's going on. The last thing that I want to touch on, because there has been some changes with the ERC, and I know that you guys are tired of hearing the ERC. Let me tell you a couple things, because I'm going to get on my soapbox on this in a second. First, I want to tell you that there is a bill out there that is proposing to reinstate the fourth quarter. Will that happen? Boy, I kind of think it's a long shot at this time, but the National Restaurant Association is pushing hard. I've been working with them throughout this year on ERC. I've given them some ammunition on things that they could bring to their lobbying efforts. And they're pushing hard on this. They're pushing hard on this. They're pushing on restaurant revitalization grants. I mean, restaurants are getting hit hard again now, and so they're working hard. So we'll see. It very well could happen, but right now that's just a proposal. I'm going to come back. Well, this is where I'm going to get on my soapbox for a second. as tax preparers, as advisors to your clients, you know your clients are being bombarded with ERC marketing. It just happened. This is the most marketed credit in the history of the world. And this is out there. There's a lot of misinformation out there. So I'm going to sound like I'm, um, I guess the bottom line is be leery sometimes if you have clients in industries you don't think are going to qualify. They're being promised huge credits. Be a little concerned about that. Doesn't mean they don't have it, but make sure you vet the process. Make sure you vet the qualifications. And the math is easy. You know, if a client qualifies on a drop in revenue, we can all see that. Now, there's certain rules with aggregation you got to make sure you bring into play and all that. But overall, the math rules are easy. It's the government orders where people are pushing the envelope in my mind. That government order has to restrict me personally to qualify for this, or I have to indirectly be affected by, let's say, one of my suppliers being affected. I'm seeing a lot of credits being pushed based on supply chain, and it's really hard to equate supply chain issues to government mandates. Generally, we have seen it. A lot of supply chain issues, just demand went way up. If someone's saying, yeah, well, you know, you can't get this, so you qualify, that's not far enough. You can't get this product that you need for your business because they were shut down by a government mandate and now that's trickled down to you. That's the scenario we want to look at, not just I can't get it. And so that, be aware of that. Be aware if a client's ERC is being qualified based on a lack of demand argument, you know, your customers were shut down, therefore you qualify. Now, at times I think we can do that, but IRS and IRS Notice 2120, I think, came out and said lack of demand is not enough to qualify you for ERC. And I'm seeing a lot of that. If somebody's saying they can qualify because they had to put up plastic partitions in between desks, no, that doesn't qualify. This is my opinion. If somebody's qualified because you had to work at home, well, no, the IRS notice specifically says if you could work at home, if you could work remote and it didn't disrupt the business, you don't qualify. So those are that's my soapbox. I'm going to get off that for a second. One thing that I want to point out is, and I'm actually looking to let John go over this section here. IRS, you know, got rid of the fourth quarter ERC. Some clients took advantage of that by reducing deposits. John, how's this situation sitting right now with catching up with payroll tax deposits?
Sure, Randy. Well, it's really just a matter of there's one more opportunity to get clients on board to avoid penalties and such. And so, and again, this came about when the Q4 ERC was repealed for regular candidates. And so what we've got here is, in some cases, the taxpayer was able to get an advance payment. In other cases, they were able to reduce their deposits, their payroll tax deposits for the fourth quarter. So what we've got remaining is there are normally penalties for failure to deposit. That's by the boards. Those are generally waived. Today, there's one last opportunity that you could talk to your clients about, and that's the penalty for failure to pay. Different than for failure to deposit. This is the one due on January 31st when your clients file their Q4 2021 payroll tax form, the 941. If they're still in arrears through this Q4 repeal, they're only getting penalty waivers up and through January 31st. And so if they do not true up and get caught up by January 31st, they will be subject to the failure to pay penalties. And those can be up to 25% plus interest.
So definitely worth getting that taken care of. I'm going to put the fourth polling question while I go over this last section here. Thanks, John. What I want to do is I want to talk to you about interplay between ERC and R&D tax credits. This is IRS just came out with their instructions for Form 6765. Form 6765 is what we claim R&D tax credit. On this form, there's some confusing if you look at it on the surface, some confusing terminology on there, because what it talks about is the interplay with the ERC from January 1st, 2021 through June 30th, 2021. And it's treating that different than it has another explanation that says, okay, employee retention after June 30th and before January 1st, 22, we do this other thing. What they're trying to say there, if you look at the IRS notices, IRS notice 2123 and IRS 2149, and 2123 talks about the first 6 months of 21. In there, it basically says you can take the ERC on employee wages in the first 2 quarters, and you basically, there's a ordering system in there and says, and then whatever's left over you can use for R&D. That's really what it's trying to say. It's not clear, but that's what they're trying to say. Then in the last 2 quarters, they reverse that in the 2149 IRS notice where they say, okay, now you take the wages for the R&D tax credit and whatever's left over you take for ERC. Most people don't know this. Most people assume that that was wrong. It is confusing. If you look at the instructions on 66, 67, 65, they're specifically saying that. And in 2149, there's a footnote on page 16, if you want to pull this up, a footnote on page 16 that says, hey, we did the inverse ordering rules in the second half of 21 compared to the ordering rules of when we use wages in the first half of 21. So be aware of this. You know, there's probably clients you have that took a 3rd quarter credit that want to take an R&D as well. There may be some issues with the wages being used for ERC first rather than R&D. Maybe there's clarification where IRS will come out because it is confusing. ERC was available first. You could do ERC at the end of the 3rd quarter. You couldn't do your R&D tax credit yet, at least if you're a calendar year filer. So it's, in fact, I've got 2 calls on this alone in the last 24 hours from CPAs that I deal with that we went, one of them, a good friend of mine, Jim Brandenburg, great guy, knows this stuff. He and I went back and forth on this to interpret this, and then he really helped me on this. So just be aware that's out there. All right, I've got this poll question number 4 answered, and about just over half of you think that a version of the BBB will be passed this year, which you know, I wasn't sure where the percentages would come in on this because it's an iffy one. I think I something will. I think the 179D, I think the 45L will be addressed at some point. I did follow in question number 4. You guys are gonna get the slides. Just if you want to take a screenshot here or anything, there's John's information. He can answer questions for you. There's my information. I really appreciate you guys being here. I kept it less than an hour, which was good. We got our 50 minutes in. We got our CPE. Thanks everybody. And any questions, honestly, email me, email John, call me, call John, and we will answer anything we can. I'm getting a few things in the chat. Just see if there's anything I need to answer. And oh, thank you. Thank you very much for thanking me and John. All right. Good night. Not good night. I'm in New York. Where am I? California. Good almost afternoon, and enjoy the day, everybody.